dividend ETFs. They've been investor darlings this year. DJ, your dividend equity ETF, SCHD is the symbol. This is your largest ETF. It's one of the top 25 ETFs by assets out there. I'm looking at the inflows, huge inflows this year, and it's only down 3%. So explain how this happened. This seems like a combination of growing dividends and defensive stocks. It's a very potent combination this year.
Yeah, SCHD has enjoyed very healthy inflows for the last few years. 2022, the largest for sure. This space has done well. It seems advisors and investors that are looking for income, that might have been wary about looking for that income in the bond market with rates rising and prices depreciating, have found comfort in dividend strategies. It's the largest category to have inflows by factor. And then the Schwab U.S. Dividend ETF has had a strong track record. If you look at its performance characteristics over the last 1 year, 3 year, 5 year, 10 year, it compares very well in the category. And then it happens to also be the least expensive ETF, dividend ETF in the space as well. So it's got a lot going for it.
And it does pay. It's not like the dividends are that much amazingly different than the S&P 500. It's really, you're in defensive sectors this year.
Yeah, absolutely. The play here is it's kind of a combo play. On the one hand, these are defensive equities, and for folks who are a little bit, shell-shocked from this year, the move to defense has been very clear. At the same time, we have 2 million excess retirees from the pandemic. Those folks are restructuring their portfolios to generate income, something like a CHD, which is cheap and delivers all day long.
So you have a poll here. This is one of the great things about being with VettaFi, which is Dave's with. They do polls all the time. So I can use these polls. 970 advisors at VettaFi, 62% said they're adding to dividend-paying strategies combat inflation and interest rates?
Yeah, so we ask them all the time, what are you doing to portfolios? It's the number one question we ask. We ask, what are you doing to portfolios to deal with inflation and rising rates? The number one answer was adding to dividends. Number two answer, looking for value stocks. Number three answer, short-term govies, right? So you've definitely got a spread there in terms of risk and reward.
Yeah, well, so are we still seeing, DJ, is this going to be a story in 2023? I know it's hard to figure that out. If growth stocks make a comeback, I mean, dividends are not going to be as popular because it's a hard game to say here. This was the perfect year for the dividend play, right?
Right.
Yeah. And so now the viewers are going to say to me, oh, that's nice, Bob. Good for you to review the history of 2022. How about 2023? What's going to happen there? I'm not. Yeah, well, I know you're not a strategist, DJ. Yeah. I'm not trying to put you on the spot, but that's the question the viewers want to know.
Yeah, that's okay, Bob. I'd point out that dividends and value, right, dividends are related to the value factor in some way, and that high dividend stocks tend to be more value-oriented. Growth trumped by value, not just in 2021, but over the last decade. Right, so there's a lot of catching up to do on valuations in the value space. And by the way, the SCHD scores high in the value factor. So this is not a 1 year, not likely to be a 1 year phenomena. Look at the growth that the technology companies delivered to the U.S. indices over the last 5 to 10 years, and companies in SCHD, which just have some information technology, but it also has a lot of financial services and consumer discretionary. So these companies have strong balance sheets and have a demonstrated history of growing and paying dividends. So this is not just a 1 year story. The demographics of baby boomers in retirement, where dividend strategies can be beneficial, has a lot of legs to it.
I certainly would like to see the value outperform for more than a single year. When you see energy at 3% of the S&P, all right, now it's 5%, will be. That's kind of depressing, considering at one point it was close to 30% 30 years ago.
I think that's part of why people look at dividends. I mean, 96% of dividend payers kept them flat or increased them in the third quarter, even while there's a lot of discussion about some shaky earnings. This is a statistic, this is a thing a company can do to keep investors interested in their stock, maintaining or increasing that dividend. No. Tough for a value company to do that out of the gate.
Well, we saw this with energy stocks, right? I mean, look at there was a small group of exploration and production companies that were offering variable dividends this year, depending on the cash flow, which sounded fabulous. All of a sudden, they're getting 9–10% dividend yields. But if the cash flows drop,
yeah, nobody likes it when the dividend gets cut, ever.
Yeah, but they call it variable. So they have a fixed dividend and then a variable component on top of that.
Sure.
And you say, don't be mad at us. We're calling it a variable. If its cash flow goes down,
well, I guess it's that or stock buybacks, right? That's the world we live in.
Sure. So people are trying to figure out ways to return money to investors. So I certainly understand that. What happened, DJ, to the inflation play? Everybody wanted inflation-protected bonds, TIPS. It was the big thing last year. This time last year, you and I were doing stories, Dave and I, about TIPS. You have your own TIPS fund. SCHP is the symbol. But there's been outflows all year in these funds. So what gives here, DJ? What's the right way to look at this as a hedge against inflation?
Yeah, so 2019 and 2020, inflation started to really crop up as a concern for investors. And so we did see a massive inflow into TIPS ETFs in 2020. And so I think 2020, 2021 even. And so I think what you're seeing in 2022 is just a little bit of the pendulum swinging the other way. Is inflation as big a concern right now moving forward as it was a year ago? Probably not. Investors might have made tactical allocations towards TIPS ETFs, and maybe they're pulling that back a little bit. So that's how I would probably assess what we've seen in flows this year. We still think TIPS make a really good place to be in a tactical asset allocation plan for the long haul. And so there's still a place for them. And actually now, with the rate move upward and inflation break-evens, they might make more sense right now than they did a year or two ago. So we still believe in them for the long haul.
You messaged me that TIPS were driven more by sentiment than reality. What does that mean?
TIPS are one of these things that are notoriously difficult for even really great traders to get right. I mean, the old adage is by the time you've decided to make a trade in TIPS, either in or out, you're probably wrong.
It's over.
And we're seeing that right now. We've had massive outflows in TIPS, but the break even on the 10-year TIP is 2.3%, which means you have to believe inflation's going to average less than 2.3% to choose a straight treasury over the 10-year TIPS. I think that's a pretty good bet right now. As DJ was saying, like, now might actually be the right time to get in. I think this is just one of those chronically mistimed sectors in the market.
You have to get it exactly right. Now, the second choice for advisors that you mentioned in your survey is value stocks this year. Now, of course, as DJ mentioned, this overlaps a little bit, but with the dividend story. But we're clearly back in the Tina but scared camp.
Exactly.
Tina meaning there is no alternative, but we're scared. So, in other words, be in equities, but be as safe as you possibly can.
Yeah, and we've seen interest in values, dividends, all of those defined outcome products have done very well in terms of gathering assets and in terms of what they've delivered for investors. All the downside risk hedging varieties, of which there's dozens and dozens, they've all pulled in decent assets. Most of them have done what they've said on the tin. The question is whether or not investors are going to get the timing right on those things as well.
You have a value fund, DJ. What are you hearing in terms of? I don't have any data on your fund in terms of flows this year. But what are you hearing from clients?
Yeah, we've got a number of strategies that have the value factor, SCHD being one, SCHV for value being another, as well as the fundamental index approach, which tends to score high on the value factor. All of those have had relatively healthy inflows this year. So, to us, it's just heartening that in the face of a very tough year, we're still seeing investors in aggregate utilize ETFs as a long-term investment vehicle. We've actually, by the way, the growth factor has actually seen decent inflows this year in the face of really, brutal price depreciation and growth. So, again, we're not as tactical and trying to call things on a month, quarter, or year, but in terms of a long-term allocation, these things make a lot of sense. And that's really what we would conclude you see in the massive flows in the face of a really tough year like 2022.
It's remarkable, though. You're still seeing inflows this year, DJ. Is Schwab overall still seeing inflows, right?
Yeah, so we have 29 ETFs, and 25 of them have had inflows. We've had outflows in 4 of the 29. So just like the rest of the industry, more inflows than outflows.
It's just remarkable, just the continuing inflows, whether the market's up or the market's down. If there's any trend this year that is clear, though, it is that Vanguard keeps hoovering up assets. So we always talk about the big 5 here, folks. And they are not far from overtaking, Vanguard is not far from overtaking BlackRock as the largest ETF issuers. What is it about Vanguard that keeps hoovering up assets?
I mean, it's a couple of things. I mean, first of all, they tend to be, if not the cheapest, very cheap in every place that they're competing. So I think that's a big piece of it. The other thing, too, is I think people now are starting to understand the Vanguard story a little bit. They're understanding the idea of mutual ownership, and it's really hard to compete with a competitor who is essentially acting as a bit of a nonprofit. I mean, not technically, but they're really
they're a mutual company.
They're running the company at cost as best they can. Really tough tough to compete with. I think people are associating that brand value with safety, whether or not it should be or not. And I think that's really compelling.
Yeah. So the top five, I want to put up that list again. We always talk about the big five. BlackRock is number one. Vanguard is number two, but it's closing in on BlackRock. At State Street, Invesco, at Schwab's there too.
Yeah, Bob, we'd be number 5 there on that, right after Invesco,
yes.
by the way.
I'm going to make sure that 268 billion is what I have. I'm not forgetting about you, DJ. I'll get your chances there to get in on that. And you've done Schwab's done an amazing job. In the last 10 years, remember they were not a significant part of the ETF
I had one of those ETF nerd bar bets when Schwab launched about how quickly they would reach 10 billion in assets, and even I was too pessimistic. I mean, they absolutely rocketed straight out of the gate. They delivered great products for the average Schwab customer. Of course, they've done well.
And what do you attribute your success comparatively, DJ? Here's a softball question, if there ever was one. Okay, so here's your chance to have the one softball question.
Well, I'll surprise you and say I'll participate in that Vanguard discussion and say Vanguard does a lot of things right. They like us, oftentimes we just try and see the world through investors' eyes and offer low-cost investment strategies that do what they're supposed to do and track the index. So they do a good job at that. I think the market looks at us as, hey, it's a welcome alternative. Right? Is it a healthy marketplace if you've got 2 providers that really overwhelm the entire industry in terms of asset growth? So I think that we're being welcomed as an alternative. We have scored really well in terms of inflows competitively for the last few years. I think we're number 4 year to date among over 200 ETF providers. So it's a very competitive space. And I think that we've been able to, do what Schwab's known for doing, which is look at the world through the investor's eyes and bring low-cost, diversified products that help investors achieve their long-term objectives. That's really all we do.
It really helps to have a huge and loyal
distribution.
Distribution center.
Doesn't hurt.
And just a famous brand name. It's Schwab is one of the real.
I think those brands
originals.
Really do matter, right? I mean, when you think about names like Schwab and Vanguard, right? These have very positive brand associations. They're very storied, older brands in the space. Yeah. People look to those as signs of safety and comfort.
Yeah, they're trusted.
Yeah.
And
beyond that, I would say beyond our distribution channel, I would point out that a significant portion of our flows this year, last year, the last few years have come from what we call off-platform. In other words, having absolutely nothing to do with Schwab's distribution, branch network, or even advisors at custody. So we do have institutions that are now noticing our ETFs that are at scale, right? An average of over 10 billion each ETF, and they're utilizing them for liquidity, and again, as an alternative.
If you want low-cost index, you're competitive up there, right? Your TIPS fund is lower than TIP, right? I think your fee is lower than TIP, right?
Yeah, not just a little. They follow the same index. TIP's got a 19. TIP's got a 19 basis point expense ratio, and SCHP's at 4. So that's not really close, and they track the same index. And take a look at the comparative returns. SCHP holds its own pretty well.